Maintaining your balance is one of the most difficult things about being an investor. In the short term, stock markets are driven by greed and fear. When things are going well, it can be easy to be overly optimistic. When markets are buoyant and share prices are rising, it can be hard to imagine they can also fall. Then when they do, it can come as a big shock. Then investors can suffer the opposite problem, excessive pessimism. When markets are plunging, as they did in 2008, it can be difficult to imagine they will ever rise again, but they nearly always do. If you're thinking about where to invest your stocks and shares ISA, it's important to get this balance right. 2013 was a very strong year for stock markets overall. So far, 2014 has proved disappointing as the mood on stock markets has become more cautious. That doesn't mean you shouldn't invest, but it does mean you should have realistic expectations. There are good reasons for the more downbeat sentiment this year. At the start of this year, the concern was that markets had rallied too far, that we needed to see more profits growth from companies to prove that the recovery from the Great Recession of a few years ago was real. Unfortunately, the news since then hasn't been good enough to keep markets going. The polar vortex that hit the US at the end of last year slowed the world's largest economy down. It's hard to tell from the blizzard of economic data whether that slowdown is temporary or more fundamental. There's no doubt, though, that Janet Yellen, the new head of the US Central Bank, is reducing the amount of money the Federal Reserve pumps into the US and world economies. That's why emerging markets have continued to do badly. Meanwhile, there's no doubt either that China, the world's second largest economy, is slowing down. Its leadership want to curb the breakneck speed growth of previous years. The question is, can China slow down to a more sustainable speed without hurting the global economy? Japan was the best performing stock market last year, but it is struggling to keep pushing down the value of its currency, the yen, which is making some investors doubt whether it can keep its recovery on track. To cap it all, the tensions between Russia and the West over Crimea threaten a return to the Cold War. Sanctions could derail Europe's very sluggish recovery. Nevertheless, we have had good news here. The Office for Budget Responsibility recently raised its forecast for growth in the UK economy. Ultimately, that's good for the UK stock market. It would be foolish to think that the share prices could rise year after year, but equally, it would be silly to think that the stock market could not advance more from here either.